What's going on, everyone? Lolit here. Today we'll be talking about calls versus puts. We'll be using Tesla as a case study example, and before we get into the numbers, I'll start us off with an analogy to kind of explain what in the world option contracts are. And so, with that, we'll get straight into it, but thank you so much. Let's get into it. Before getting into the real numbers, I wanted to talk about a call option with an analogy of the latest iPhone. So imagine if the latest iPhone is coming out, and let's say it's rumored to be $2,000. If you had an option to buy that iPhone at $1,500, but you had to spend, let's say, $10 for this option, would you do it? And so the rumor is 2000. You don't know if it's going to be actually 2000. But if you could lock in that price of 1500, and let's just say that 1500 was the minimum that Apple is going to release their latest iPhone as. So if you're going to pay $10, basically if the phone releases at 1500 bucks, you spent $10 plus the 1500, and so you got your phone at 1500, but you spent $10 which went down the drain even though it never really came into use. But let's say on the other hand, Apple releases their iPhone at $2,000 and you got it at 1500 because you locked in that price by spending that $10. Now, that difference is huge because off the bat, you just saved $490 by choosing to get into that option contract. And so, let's say this deal that it's going to be $2,000 is a rumored price. And you think that, okay, let's snag a lot of these at 1500 because even if it's not 2K, it could be 1600, 17, 18, 19. Basically, it may be worth it for you to pay some type of price for you to get into this contract, into this option contract. And so in this case, each option contract, it consists of 100 shares. And so with these iPhones, let's say the minimum order quantity was 100 iPhones, and you'd be willing to pay some type of premium for each type of iPhone, aka this amount of insurance, for example, for each type of iPhone to lock in that price. So if that insurance costs you $10 per iPhone, and let's say you want to buy 100 of them at $1,500, thinking that it's going to be at least more than that, then basically your break even price in general would be that $10 plus whatever that actual price you're intending to buy the iPhone at, aka $1,500. And so that break even would be 1500 plus $10, which would be $1,510. And so realistically, any amount of money you got or get above $1,510 is basically pure profit. And so getting into this contract, this option contract, gave you the ability to buy something at a future date, at a future price, and all you needed to do was basically give up your insurance or that premium. And so premium in a contract is basically the other word for the contract price. And so that $10 you're paying is basically the premium, but that $10 is per share. And so each contract is that $10 times 100 iPhones, aka $1,000. And so if you see the example through, if we spend $10 to lock in $1,500 and we sell it at $2,000, that's 490 profit per phone. And so in a contract, since there's 100 of them, that's 490 times 100, leading to $49,000 of pure upside given the whole circumstance and the situation, and all you needed to be willing to pay was $1,000. Now, on the other hand, if that doesn't go through, let's say the phones actually are selling at 1500 at cost, then yes, that $10 that you spent, it basically wasn't worth anything. But let's say if it was 1550, you still spent $10 and there's that $40 of difference because your break even is 1510 and the sale price is 1550. So technically if you only want to keep, let's say, one iPhone for yourself regardless, you could still sell the other 99 just because, and that's pure profit because you've already locked in that huge wedge before the fact. All right, so looking at Tesla. You got Tesla, it's sitting at 406 and 75 cents. So this is after the market is closed. So everything here is going to be static in the good way for the example that we're trying to go through for calls versus puts. So it's sitting at 406.75. Over here on the screen, what we see is select a strategy. So there's a lot of different strategies within the option and options realm, but we'll stick to calls and puts today. So you got an action, you can do buy or sell, and the two types of options in general are calls and puts. And so the options you have in general are buy to open, sell to open, buy to close, sell to close. So we'll get into more details as the video progresses. So you can buy one contract, which is a minimum, and each contract has 100 shares, as we discussed. And so if you actually do 100 in terms of quantity, then you'll be controlling some outcome with 10,000 shares instead of just 100 shares. Now, expiration is basically saying, hey, by a certain date, and it depends on the stock, but usually these expiration dates are weekly if you're dealing with, for example, Tesla, or pretty much any high volume or hot stock. Now, if you're thinking about SPY, the S&P 500 itself, if you type in SPY, you have expiration dates every 3 days because that's just how much volume and liquidity there is with that type of option play. So coming back here, you have expiration on November 6th, and if you see down in the drop down, it's weekly over here every 7 days. And the strike price is basically saying, hey, this is the price I'm willing to buy 100 shares of Tesla in the future, and I'm willing to pay some premium for that. And so this premium over here is $14.75 in terms of bid, and the ask here is $15.35. So the bid and the ask, what it really means is saying, hey, I want to bid, let's say at minimum, the bid is $14.75 in terms of open orders. So someone is willing out there to spend $14.75 to actually get into this contract agreement. And on the other side, someone has those Tesla shares that he or she is willing to actually sell at this price of $410. And so they're saying, hey, they're asking for $15.35 per share, aka the total contract price would be $1,535. They're asking for the right for someone to get their Tesla shares at $410. And in general, the people who are willing to get into that deal are willing to pay $14.75. So there's something called a bid-ask spread, which is basically the difference between this bid price and this ask price. But in general, the farther they are apart, it could mean a lot of things, and there are factors that go into it. But the closer that these prices are also means that there's a lot of volume traded on those contracts. And so if you want to get that price of, let's say, hey, I want to get that price of $14.75 for the contract, you can do it. And it just depends. But it depends if someone else is willing on the other side to do it. And that's for Tesla or any other stock in the stock market. And so finally, the type, you got calls and puts, as mentioned. And in terms of price type, you can do market, limit, and there's some other options, and it depends on your brokerage. But duration, you can do good for a day in this case. And all or none and all, I'll leave out the details of here. Now, looking on the right side, you got the options chain. So that's a technical term for basically saying that for all of these different option contracts at different prices at different dates, what is that premium that's associated with it? And so looking over here for November 6th, essentially you have calls over here on the left, puts here, you have a bid ask, strike price, and a bid ask for the put side. And so in general, it's basically what we were saying, that if someone wanted to buy or have the right to buy Tesla 100 shares at $410 on November 6th, they could lock in that price by spending this much per share. And so let's just say it's $15.35 for simplicity. So if they spend $15.35, coming up back to that concept of break even, basically that would be 410 plus 15.35. So 425.35 is your total net cost per share of Tesla. So let's just say, just for whatever reason, if Tesla went to 450 and you locked in that price of 410, you spent 425. That's true. But if you went to 450, then literally you have that whole $25 per share huge type of profit potential, aka $2,500 profit potential, by spending this 15.35 upfront in the first place. And you can just keep your Tesla shares long term after the fact, but the point is that this call option allows you potential profit that maybe wouldn't have been able to be realized without the contract. And so that's where options also falls into derivatives, and if you've heard of futures, etc., they're different tools, basically derivations of the actual stock price. That is basically how these contract prices are made up. So now coming over here, basically it says help me choose a strategy. So you have call option long call and call option short call. So the difference between long call and short call is essentially that, hey, you're saying that, hey, I think Tesla's going to go up. And so your long call basically is saying that you think it's going to go up, and the opposite on the other end. And that's just super high level. But when looking at the graph over here, basically you have this break-even point, strike price, and the graph is set up like you have a stock price over here, and on the y-axis you have profit, loss, and zero. So what this is saying is you're saying that, hey, this price over here, so imagine if this was just arbitrarily, let's say it's $50, or rather, let's go over here and use a real example. So if it's 410, let's say it's 1535. So going back to the graph, we're saying that we're willing to spend $15.35, saying that I want to lock in my price for Tesla at $410. Now, over here, the profit is, it's infinity. And so what that means is, as the stock price goes up, this profit potential also goes up. Why? It's because of the same reason where if we're locking in the price at 410, and let's say Tesla zooms to 500, then basically you already locked in 410, but Tesla could go to 450, 500, 1000, 5K. It just depends on the duration of the contract, when you're actually trying to execute the actual contract, aka the expiration date. And it all goes back to what premium are you willing to pay and what price are we talking about. So those three factors primarily. So your profit potential is unlimited, but let's say that Tesla just goes down, let's say to 350, for example, and we wanted to lock in that price of 410. Well, when the date actually comes, aka November 6th, does it make sense to buy 100 shares for the agreed upon price in the contract of 410 when the market price is sitting at 350? Of course it doesn't. And so when it doesn't make sense, basically what we see here in terms of loss is that you have a loss amount over here, which is basically the price of the contract that you paid. And so if it goes down, you had the option and you spent some in terms of premium, aka the contract price, but if it didn't make sense, it doesn't make sense, but you had that insurance, you had the option. And so on the flip side, you can exercise the option. And so with the same example, if Tesla's higher than 410 and November 6th comes around, then you can definitely shorten that period and just exercise your contract. And guess what? You'll have 100 shares of Tesla with that average cost of being $410, and you can do whatever you want after the fact. And so on the other hand, you have a short call. So over here, we have buying a call, aka on the long call, it's like buying, and on the short call, it's like selling. And so buy call, sell call. So what's the difference? So buying a call is basically saying exactly what we're talking about here. Now, selling a call is the opposite. And so when you're buying a call, you don't have the shares, and you're willing and wanting or desiring, or however the strategy is, to get these shares in the future. Now, you can trade purely on the contract price, but we're assuming that we're dealing with the actual shares and we'll hold it all the way till expiration for simplicity in this example. So if I don't have 100 shares, but I'm willing to buy them in the future, then I'm basically paying somebody on the other side who has those shares. And so that premium that we're paying, it goes to that other person who has the shares. And so when you're short call, aka selling a call, you have 100 shares of Tesla already. And so let's just say I had 100 shares, and let's just say that I had them at 406 and whatever change it was on the actual day. And so if I'm willing to sell my shares at $410 and I'm getting, let's say, that $15 approximate premium per share, then I'm collecting $1,500. And it's 1 week until November 6th. And so what that means is 1 week till November 6th, and I'm getting $1,500 in premium. I could do this every single week by selling calls. On the other hand, what I'm getting at is if I have my shares at 406 and I'm willing to sell them at 410, I'm getting that $1,500 upfront from the other person because I'm giving them that right. And so from the graph, the profit over here is capped out at that actual amount that I received in terms of premium. Now, here's the story. As the stock price goes up, the contract itself also goes up. And so the higher it goes, I'm already capped out because I've already agreed to sell someone my shares at $410. So if it goes to 450 or 500 or wherever Tesla goes, I won't see that extra profit potential. So there are some cases where some folks say that, oh, you're leaving money on the table. But on the other end, it's more like you got exactly what you wanted. So you're kind of like locking in profits or whatever the strategy is in terms of selling a call on the other side. So to reiterate, long call, profit potential equals maximum. Short call, you got a limited profit potential, but you're also de-risking yourself and using it as a hedge, because what happens is, let's say I buy 100 shares of Tesla at $406 change, and I want to sell a call immediately to give someone else the right to buy them at 410, then at least I know that, hey, I am getting a huge profit in terms of exactly what I want, and it's guaranteed because it's on a contract basis. But at the same time, I'm also getting a premium up front. So you're getting income in two ways, where there's premium, and if the stock goes up, then basically you're getting profit in that way as well in terms of capital gains. Else, at least you kept the premium. So there's a way to get money from selling calls, in this case, upfront, and it's guaranteed, but you are missing out on the profit potential depending on the situation. So right before the graph, a put is basically the opposite. And so a put is basically guaranteeing that position for somebody else to take your shares in the future at a certain date at a certain price. So for example, if I thought, and this is 2020 at the time of this recording, and the Rona, let's say there's a second wave, what's going to happen? Everyone thinks there'd be a stock market crash. And so the point of that is, basically, if you buy a put contract, let's say you think that Tesla may go, just for an example, from 400 all the way to 250. Now, if someone gave you that option, aka you could buy a put option contract to sell your shares at, let's say, 350, then if you think it's going to go even lower, then that's fine. You can buy it back at a future time. But the point is, you're locking in some potential. And so let's just say you bought Tesla at 275 and you've wrote it up to, let's say, 406 right now, and you're willing to let it go at 375. So you can get into a contract and buy a put contract, so someone else can buy those shares. Let's say at that certain date of expiration, it falls to 250 like you thought, but you'd be getting 375. And so to get into that contract, you'd be paying some premium. And it's the same story coming back to break-even price regarding call options, put options. It's the same, pretty much similar math. And so if you look over here, this strike price over here, and then this break-even point, basically when you're buying a put, you are spending more for that right, and you're paying a premium. And so it makes sense that your break-even point would be even lower than what you're executing as. Why? Because you're spending money and you're getting money. So if you're spending, let's say, $10 in premium per share, and let's say that you want to execute at $375, you're really spending $385. And so this break-even point is basically saying that, okay, you need this stock to go even $10 lower for you to break even. And so 375, and then this would be 365 for you to actually make money in that situation. And so short put is similar to selling a call, but here you're selling a put, and instead of you having the shares and then you're giving someone else the right to have your shares, it's actually that you have cash. And so a cash covered put, basically you have the cash to buy someone else's shares at a future date at a future price. So on the other end, somebody has $37,500 and they're willing to use that as collateral, and it's all automatic in the back end saying that, hey, I have 37.5K and I'm willing to lock this up until the expiration date, because if it makes sense, then I may be the owner of these 100 shares and they're fully mine. And so they'd also be receiving that premium from the other side, from the person who's buying the put. That money for that premium, that contract price, goes to the seller of the put. And so if I'm spending $37,500 and I'm selling a put and I got 100 shares, chances are, and it depends on the contract, the dates, etc., but basically, let's say if I received a premium of, just an example, $20 a share, then realistically, I made 20 times 100, so I made $2,000, and all I had to put up was $37,500. But it's not about the actual amount or not; it's about the case actually happening. And so there's different probabilities and different strategies and why of when to use puts, when to buy, sell, and when to buy, sell calls and puts, but it just depends. All right, thank you so much for coming to the end. Leave a like, share, subscribe. You know how it is. My name is Lalit again, and with that, cue the outro. Okay. Yeah. Peace.